If you work as a server, bartender, hairstylist, or delivery driver, you already know your tips are the lifeblood of your income. For the 2025 tax year, the IRS has created a brand new deduction specifically for tipped workers, allowing you to shield up to $25,000 of your tip income from federal taxes. Right now, there are an estimated 6 million workers eligible for this money, but as of early March, only about 3.5 million have actually claimed it. Millions of people are leaving thousands of dollars behind, simply because they do not know how to fill out one specific piece of paperwork. That paperwork is IRS Schedule 1A. We are going to walk through it line by line. Once you know exactly what to put in each box, you can keep that money in your own bank account. This new tax rule was created by the One Big Beautiful Bill, which was signed into law on July 4, 2025. The law applies exclusively to a 4-year window, covering tax years 2025 through 2028. You are filing for the first eligible year right now. It is important to understand exactly how this mechanism works. This is a tax deduction, not a tax credit. A credit directly reduces your final tax bill dollar for dollar. A deduction works differently. A deduction lowers the total amount of income the IRS is legally allowed to tax in the first place. If you are in the 22% tax bracket and you deduct $20,000 in tips, you shrink your taxable income pool by that exact amount, saving you $4,400 on your final tax bill. Before you fill out any forms, you have to confirm you are legally permitted to take this deduction. The IRS maintains a strict official list of nearly 70 approved tipped occupations. This chart shows approved categories. If you work in food and beverage, hair and beauty, hospitality, or cleaning, you are eligible. However, the law explicitly excludes certain professions. You cannot claim this if you work in healthcare, law, accounting, performing arts, athletics, or consulting. The IRS defines eligible workers as those who customarily and regularly receive tips. Checking your exact job title against the official list at irs.gov/tippedoccupations is the mandatory first step to prevent an audit. To get the full $25,000 deduction, your modified adjusted gross income, or MAGI, must fall under certain limits. MAGI is your total income minus specific standard above-the-line deductions, like student loan interest. The limit is $150,000 if you file as single, or $300,000 if you are married filing jointly. If your income goes over that limit, the deduction starts to phase out. The rule is exact. Your maximum allowable deduction shrinks by $100 for every $1,000 your income exceeds the threshold. Let's walk through an example. Say you are a single filer with a MAGI of $165,000. That is $15,000 over the limit. Divide that overage by 1,000 to get 15. Multiply 15 by the $100 penalty to get a $1,500 reduction. Subtract that from $20,000 in tips. Your final allowable tip deduction is $18,500. For most tipped workers, income stays well below the threshold and the phase-out does not apply. But for higher earners, running this MAGI calculation prevents you from accidentally overclaiming and triggering an IRS correction. Now let's get the paperwork done. Start by finding your total qualified tips. If you are a standard employee, look at your Form W-2. Box 7 is labeled Social Security Tips and contains your exact reported tip income. Take that number and open IRS Schedule 1A, the new form for additional deductions. In Part 1, enter your adjusted gross income from your main return and add back specified deductions. This establishes your MAGI on line 7. Next, scroll down to Part 2. Enter your total tips on line 8. Line 9 caps that number at the statutory maximum of $25,000. On line 11, enter any phase-out penalty you calculated, or 0 if your income was under the limit. Subtract line 11 from your capped tip total. The result goes on line 12 as your final allowable deduction. You have to transfer this number to your primary tax return. Take the total from Schedule 1A and write it on Form 1040, line 13B. Line 13B is a new designated space in the Adjustments to Income section. Writing that final number exactly on line 13B is the definitive action that officially executes your tax savings. Before you file, check your work against the 3 most common regulatory mistakes that will cause the IRS to reject your deduction. First, claiming tips from a non-qualifying job. If you are an accountant who was tipped by a client, you cannot deduct it. The IRS checks your stated occupation against their master list. Second, including mandatory service charges. If a restaurant automatically adds an 18% gratuity to a large party's bill, the IRS classifies that as regular wages. Only voluntary amounts chosen by the customer qualify as tips. Third, attempting to deduct on reported income. You cannot deduct tips that the IRS does not know about. If you have cash tips missing from your W-2, you must report them on Form 4137 and pay the associated Medicare and Social Security taxes first before you include them on Schedule 1A. Strictly adhering to the definitions of voluntary reported tips guarantees the integrity of your deduction claim. Let's review the steps. 1. Confirm your job on the IRS list. 2. Locate reported tips on W-2 Box 7. 3. Complete Schedule 1A Part 1 for MAGI. 4. Calculate the deduction in Part 2. 5. Transfer the total to Form 1040, Line 13B. You must complete these steps and file your 2025 return before the April 15, 2026 deadline. If you work hourly and log extra shifts, there is another tax benefit you need to know about. Next week, I'm walking through how to claim the no tax on overtime deduction, which uses this exact same Schedule 1A form and can stack on top of your tip deduction. Taking 10 minutes to properly fill out Schedule 1A is the most direct way to pull thousands of your own hard-earned dollars out of the federal tax pool and put them back in your pocket. As always, this video is for educational purposes only. Nothing here is legal, financial, or tax advice for your personal situation. For that, consult a qualified CPA, enrolled agent, or tax attorney. See you in the next one.